Yep.
Good morning, welcome, and thank you for joining us for this portfolio update webinar for the Amati Strategic Metals Fund. I'm Colin Thompson, one of the Amati sales team, and presenting today are the fund's co-managers, George Lakeem and Mark Smith. For those of you who haven't heard the team present before, George and Mark have backgrounds in mining engineering and geology respectively, as well as decades of financial and fund management experience. So this is a great advantage in an area where it's vital to understand the viability of projects, to be able to talk the same language as the management. One of the key advantages of the fund is the flexibility to tilt the portfolio between the various metal segments, taking advantage of the different cycles. With that in mind, the presentation will outline the long-term opportunities and the rationale for the current portfolio positioning, as well as covering the performance over the past year. The BrightTalk platform offers a facility to submit questions to the team, so please enter them on the webinar page as they occur to you, and the team will address them at the end. And with that, I'll hand over to Mark.
Thank you, Colin, and thank you, ladies and gentlemen, for attending this BrightTalk update on the Strategic Metals Fund. As Colin said, today we're going to give you an update on the investment themes and opportunities presenting to the fund currently, and give you an overview on the current structure of the fund. Thereby, after we'll open up for Q&A. This slide, the backdrop for the next decade, is really a recap. It's an introductory slide that also serves as a recap as to why we decided to launch the Amati Strategic Metals Fund as an evergreen multi-thematic fund, principally driven by value. There are many demand drivers for metals over the next decade that we've highlighted here, but the theme of decarbonising the global energy supply, I think, will act as a massive demand annuity. Since we launched the fund nearly 15 months ago, this area of investment has acted as a strong bookend to the portfolio. The other theme that's highlighted on this slide is the theme of rising debt levels, inflation and political risk, which has provided the other bookend to the fund with our current precious metals investments in the fund. And this sector currently is front and center for us. The clean energy technologies, a trend of decarbonising global energy supply to achieve a 2-degree pathway or better, will require the use of clean energy. These technologies, be it solar, wind or battery storage, will have to grow at over 10% per annum to achieve the stated climate targets. These sources of renewable energy will be very metal intensive. The global electricity networks will have to expand, with battery storage and power systems expanding rapidly to store this renewable energy needed. Indeed, the need for green hydrogen from water electrolysis is expected to grow at over 30% per year. And this clean energy source will itself require further renewable power for the hydrogen electrolyzers, all positive for metal demand going forward. The transition to commodity demand, as I've called it on this slide, the energy transition, this is going to come at a cost. And this cost is an increased metal demand. The clean energy sources creates a massive potential demand pool for critical metals, a focus of our Amati fund. If we look at a ratio theoretically of demand in 2050 over demand in 2020, we can see a potential 21-fold increase in lithium demand, a 2-fold increase in nickel, and up to 4 times use of rare earths used for the thermal stability of magnets. These are all areas which the fund is actively invested in, and will continue to look for opportunities in these areas as they unfold. Global metal demand, and we've summarized here on these charts that the metal demand for clean energy is illustrated graphically here in this slide against the other global areas of demand. So the colored charts in green and blue is the metal demand needed above and beyond what's currently needed in other global sectors of metal. It demonstrates that there's a meaningful contribution to demand, especially for lithium and nickel. Again, the fund's invested in these areas. If we look at the next decade, 2020 to 2030, we think this is going to be the most challenging for metal markets. The mining industry has just been simply too slow to respond to the potential demand wave that we see. Given it takes 5 to 10 years from first discovery to build a mine, the supply deficit is predicted to be the most acute during this decade. Put simply, not enough money has been spent and invested in finding and mining new ore bodies. This plays into the hands of our fund, and new companies will have to be financed to find and develop new ore bodies. This is a great slide I found from the Bank of Montreal, and really it's just a summary that the theme is currently not broken. They've taken a view here, and they've tried to look at the supply-demand dynamics of each metal, and then they've considered what a realistic through-cycle metal price is needed to balance the books for each metal. And they put this on a graph on the y-axis, which is potential for short-term constraints, and on the x-axis, potential for long-term shortage. They've highlighted several metals in the top right-hand corner in the green, where they see metal markets being acutely supply-driven. You want to be in metal markets that are supply-driven, not demand-driven, i.e. demand will have to adjust longer term as there's simply not enough metal. And this is the best area to be invested in for higher metal prices. In summary from here, commodities are under-owned. So when we look at the commodities on a real-term basis, they're at their lowest for 50 years. And when measured against the S&P 500, this is even more acute. Any mean reversion to this trend could see an uplift in commodity prices. Global inflation and metal supply shortages, which fuel inflation, are driving up metal prices themselves, which itself is creating a rise in structural inflation. This demand inflation is adding to an already pressured financial system pumped up by global monetary stimulus. Under this scenario, precious metals is an important asset class to consider. And I'll now hand over to George to explain further.
Thank you, Mark. We include precious metals in the fund as a risk diversifier, as Mark mentioned, as well as for tactical purposes where we see precious metal stocks being temporarily oversold. And right now, both factors are actually driving our decision to hold approximately 50% of the fund in precious metals companies. After almost 28 years of living and breathing the gold price every day, well, we don't believe that we're smarter than anyone else in trying to predict whether the gold price is going to fall over the coming months and years or rise substantially. Therefore, we really react on what we know and see in front of us and try to figure out when the market is completely positioned on one side of the trade, especially when the consensus is positioned for a significantly weaker gold price outlook. This has happened many times over the past 28 years, and generally it was the best time for investors to make good returns in trying to invest in the precious metals sector. Now, right now, the outlook for the gold price has become quite murky with real interest rates at record lows if we consider CPI or PPI. In this case, on this chart by Scotiabank, of the gold price superimposed on the 3 months T-bill, less total CPI, and this goes back up to 1968. And as you can see, we've only been here twice before, in 1974 and 1980. In the 1970s, this actually led to a prolonged period of stagflation, while in 1998 we had the response from the then US Fed chairman, Paul Faulkner, in raising interest rates to such a high that it actually put a stop to the double-digit inflation figures that we saw at the time. So where do we stand now? And it's quite clear that the high inflation figures that we're seeing are being caused by two factors. Firstly, supply chain issues, which really been caused by the COVID disruptions that we saw in 2020 and 2021. And those need to work themselves through the system, and they will do over the next 12 months or so. And secondly, the energy crisis that actually started well before the invasion of Ukraine, but was certainly heightened dramatically after the inflation. So on this side of the equation, it's trickier to predict when we'll see a meaningful relief in energy prices, or whether we're going to still see significantly high energy prices over the coming months. Inflation is also starting to infest itself across soft commodities, and we're starting to see wage increases given the tight labor market. The question for us is what the monetary policy response will be over the coming months. So far, we've seen a 75 basis points rate hike in the US since March this year, and that's resulted in the S&P 500 giving back 10 or 15 or 12% from its highs. Now, the market is at the moment pricing in another 200, 250 basis points hike by year end. And the question is whether the Fed will be able to engineer a soft landing of trying to gradually increase interest rates while getting the inflation back down to the 2.5% level without the global economy tipping into recession. In our opinion, at the moment, it seems like a soft landing is what's fully priced into the market, and certainly the gold market, with the gold price around 1850 and silver price around $22 an ounce. And we believe it's prudent to continue to hold a safe haven positioning in the fund in the form of gold and silver equities, especially when the stock's already pricing in a significant correction in precious metal prices. From a pure gold trader's perspective, it's really difficult to take or hold meaningful short-term long positions in gold in the face of a very strong dollar and rising nominal interest rates. For now, it seems that the dollar surge, especially from the beginning of this year, has sort of stabilized while treasury yields are still over 3% and look like they may be heading slightly higher. Also, with the weakening equity and bond markets, gold and gold shares are often used as a source of funds, and this seemed apparent in May with gold-backed ETFs reporting a net outflow of just over 3 billion in the month. And put in perspective, that's 1.3% of the total gold ETFs issued to date. With the gold price showing no real direction and with lingering fears that the gold price could pull back even further with real rates improving, investors seem to be shying away from gold and gold equities at the moment, despite record profit margins and vastly improved balance sheets. The chart on the left from Scotiabank shows that after gold stocks were typically discounting 40 to 240% premiums to spot prior to the great financial crisis, the stocks were fairly reflecting the gold price for the majority of the time since 2008, except for the meltdown over the past 3 to 4 years. At the moment, on average, the gold stocks are reflecting a gold price of some 17% below spot, so it's closer to $1,500 an ounce. The basket of gold equities is actually dominated by Newmont, Barrick, and Agnico Eagle, who have been priced in line with the spot gold price, which implies that many of the companies are discounting closer to $1,200, $1,300 an ounce. And this is backed up by our own financial models on the companies. Another way to look at the sector as a whole is to look at the average price to NAV of the North American producers since 1985. And you can see on the right-hand side that the range has been between 1.5 and 2.1 times NAV. As the majority of the companies exhibited year-on-year growth in their intrinsic value, mainly through the drill bit and bringing projects online. Again, since 2010 and 2011, the rating of the sector collapsed down to a low of 0.7 times net asset value. And over the past 3 years, the sector's actually been in a very healthy position with most balance sheets significantly de-risked. And companies have once again been creating significant growth through the drill bit. Yet the rating of the sector as a whole remains at 0.85 times net asset value. Again, another clear sign of lack of interest in the sector. Now, we are mindful that precious metal prices could indeed pull back to $1,500 or lower, and we'll quickly react to the change in the fundamentals. However, right now, history has shown the best time to be buying precious metal stocks is when no one is interested in them. And that's where the stock picking really comes to the fore. While companies demonstrate significant returns at spot prices, we'll continue to maintain a high weighting in the sector. We are looking at investing in sectors where there's a disconnect between the price of the companies and the underlying fundamentals. We're not trying to trade around day-to-day movements in the underlying metal prices. However, it sometimes gives us great opportunities to add to positions, as we recently did with the silver stocks in the portfolio. And silver is gold's more volatile cousin, as we saw last month, with the gold to silver ratio jumping up to 88 times when the silver price quickly retracted from $26 an ounce. This led to an exaggerated sell-off in the silver companies, and then a significant rebound when the silver price held $21 an ounce and moved back up to around where it is today, $22 an ounce. So stepping back a bit was quite interesting to note. BMO published a report on May the 27th showing the silver sector as a whole trading at 0.91 times NAV, with quite a few major mining, Hochschild's, and Fortuna Silver trading at 0.6 times net asset value. Now, we don't put all our focus on net asset value because it's sometimes misleading, but just to put the sector as a whole traditionally traded at 1.82 times net asset value. And this premium is reflective of the scarcity of listed silver producers, even though the majority of silver producers today produce as much gold as silver. But I thought it's prudent to add the slide today, since it's certainly for me the lowest multiple I've seen the sector ever traded. The fear trade is probably most acutely reflected in the valuation of the developers. And this is a chart on the left-hand side showing the North American developers. And the developers, they combined commodity price risk with construction risk and capital expenditure inflation risk. Now, the sector is currently trading, as you can see, around 30 to 35 dollars an ounce of resource, which is lower than many exploration companies that don't even have a pre-feasibility study, and below the average industry discovery cost around $45 to $50 an ounce. And a great way that Scotiabank reflect this is by dividing the EV to ounce rating by the gold price at the time. In this case, you can see the developers are trading right on their all-time low rating. It's a great time for longer-term investors with the discipline to do their work in understanding the construction and capital expenditure inflation risk for each individual company, while everyone is backing away from the sector. Again, it comes to our stock picking abilities and really why Mark and I are sitting in this chair today. So with that, I'm going to hand back to Mark, who will discuss the performance to date and the current of the fund.
Thank you, George. For us, this is a key slide, and I think it really encapsulates our philosophy of the fund. The Strategic Metal Fund was designed to be a multi-thematic fund driven by value, as George has demonstrated. When we look at the fund performance over the last 15 months, we've managed to materially outperform the gold index. We've used the GDXJ and indices of 96 small and mid-cap companies to demonstrate this. But we've also kept pace with the base metals, and that's been highlighted by the S&P TSX Global Base Metal Indices in red. And again, this was achieved because we're stock pickers in the fund. We'd argue that we've provided the investor with a focused investment in the base and battery metals sector, but we've also preserved the precious metals optionality on global inflation and political risk. And I think this sector now is certainly going to pay dividends going forward. If we look at the portfolio breakdown and risk management, strength in our product comes from our backgrounds and industry experience in mining and geology. This, coupled with our financial training through investment banking, gives us the dual expertise needed to manage risk in the natural sector. And this is key, managing risk in the natural sector. We've adopted a portfolio discipline which focuses on asset class, geographical exposure, market cap exposure, and technical and development risk, which George highlighted. And that's where the opportunities lie. Understanding the development risk, you can make good returns in the short term. If we look at the asset class split, we've got no one sector is over 70%, but we retain at least 20% in gold as a risk diversifier of the fund. The fund's currently positioned just over half exposure in precious metals, and the rest is in battery metals and industrial metals, with a focus in nickel. If we look at the geographical exposure, nearly half the portfolio is exposed to the less risky Americas, again, managing risk. Our ESG and actually our HESG really drives this approach. We adopt the clean trade approach, Freedom House guidelines, and the principles of responsible investing. And what this means is we simply don't invest in companies in countries that have a not free status. And this is where, if we can't see any reasonable expectation of civil or political rights being upheld, we don't invest in that country or that company. And that's really helped us in the last 105 days with the Ukraine invasion. We had no exposure to Russia or the former Soviet Union. If we look at the market cap exposure, 49% of the fund is invested in companies over $1 billion. So we have stability in market cap and liquidity. We're going to use our industry knowledge again to assess the technical and risk developments of each investment in the fund. If we look at the top 10 holdings here, we run a very concentrated portfolio. 38% of the fund weighting is in the top 10 holdings, and that's roughly split equally between precious metal and the specialty industrial metals. 4 of the top 10 stocks are developers, and this also points back to George's point about them being undervalued. These developers and pre-production stocks, we're kind of comfortable with the risk exposure here, as we've done our technical due diligence on these companies. And these investments actually can offer quite a swift investment return as they progress from development through to production. If we look at the portfolio summary here, assets under management are just under £78 million. We've got a weighted market cap of stock at 1.7 billion at the moment. The market cap range is here is 15 million to 7.3 billion, but that $15 million is an exploration company that was spun out of a gold holding we held. So we're looking to liquidate that fund. So ideally, the market cap range of our fund is about $100 million to $7.5 billion. We've got a concentrated portfolio, as I said, of 42 stocks. Our sweet spot is between 35 and 45 stocks. And as we break that down, you can see that the focus of the fund is in production and development. And again, that dovetails into George and myself's experience in mining and geology, where we can really risk assess these investments. We've got one explorer and one royalty company where we're taking advantage here of cobalt and lithium exposure without actually investing in the DRC. We've got a lithium royalty company based in the Americas. On the market outlook here, stimulus-driven cycle is kind of coming to a close in a sense. And that has implications for the more classic industrial metals like copper and aluminium. They're still vital for global growth and supply, but we see a price consolidation phase likely over the next 6 months. The Ukraine crisis and inflation is really a risk on global recession and or stagflation, and it's these classic industrial sectors that get hit first. So we've tried to insulate the investor from that in our fund by not investing in this sector at this point in time. Rather, we're focused on the metals that are needed for the green transition. So our industrial exposure is really through nickel developers and a few nickel producers that we have in the fund. I said and highlighted right at the beginning of our presentation that the electric vehicle and the renewable energy estimates just keep getting revised upwards, and this has strong implications for our preferred sectors of investment, which are nickel and lithium. George highlighted the precious metal sector. It still remains out of favor, but as risk on investing and the headwinds start to subside, this will offer diversification in periods of systemic risk. We kind of see a natural move back for the generalist investor into the precious metal sector, as it offers strong earnings and cash flow generation, even at current metal prices. So in summary, we're a focused fund. We're doing our homework on all these sectors. We're active over all the metal arenas, and again, we're driven by value with a focus on value in the fund and a concentrated portfolio. But needless to say, we're looking at all opportunities in the fund in the sectors that we've highlighted today. At that point, Colin, I think we'll open up for questions, and hopefully we get some good questions coming through.
Absolutely. As always, the audience haven't let us down. They've submitted some very interesting questions. First one, interested to hear any thoughts around high energy prices on margins. How high prices need to go before you were worried about earnings?
Yeah, we've had this demonstrated in the last couple of quarters as the mining companies have released their financials, and what we're seeing is that energy inflation, energy in the mining industry is probably about 20 to 30% of the cost base, and that's gone up maybe 15-20%. But what's happened is the headline revenue line has increased as well. So proportionally, that we're not seeing yet any margin erosion in the profit of these companies. Going forward, what the mining companies are trying to do is actively manage themselves away from higher energy and principally heavy fuel and diesel prices by entertaining renewable energy on the mine site. So that's a trend going forward. But at the moment, the mining companies are managing their energy requirements.
Great stuff. Thank you, Mark. The next question, given the drive to reduce CO2 emissions and the unreliable nature of some renewables, where do you stand on investing in uranium, given nuclear seems increasingly likely as part of the baseload delivery?
Yeah, I can take that, Mark. I mean, we're spending quite a bit of time actually with uranium companies at the moment. We agree it's going to be part of the equation going forward. Again, it tends to be quite a volatile sector right now. We've got the Sprott Trust. I see the ATM has been reactivated now, so that's sort of distorting a little bit of the spot price of uranium, and it's again we are doing our work on the companies and saying that what point do we come into the sector at the right time and using a realistic long-term uranium price, because it's a term price that's really meaningful, not the spot price. So yeah, I suspect, and the next time we do this, the update, that we'll probably have invested in the uranium sector.
Great stuff. Thank you for that. Can you talk about thoughts on cobalt and its prospects and your exposure?
Yeah, our exposure is very small, and that's really driven because of our ESG approach to not investing in non-free countries. And cobalt is primarily produced in the DRC, hence we don't invest there. But as I said on the outset, we've got a royalty company that has cobalt royalty from a nickel mine in Canada. So we get exposure by proxy that way. I think that the biggest thing when you look at the future of cobalt is because of its non-transparent ESG nature of where it's being produced, a lot of the auto manufacturers are trying to thrift out cobalt in their nickel manganese cobalt batteries, and they don't want to be exposed to it. So that's ultimately going to be driven by the end consumer not wanting conflict metal in their electric vehicles. So I think the dominance of other chemistries in the battery makeup is going to be front and center. So we kind of see the future of battery of cobalt is primarily quite short term. If we're taking a 10-year view, I think the battery chemistries will thrift out cobalt going forward.
Great stuff, thank you. Are you expecting to see increased M&A given some of the larger gold producers are trading on richer valuations than the smaller peers?
Yeah, Colin. I mean, we see this whenever we get some stability or some upward momentum in the gold price, where we get this M&A. But it's also dependent on who moves first. And we've seen a couple of weeks ago, was it last week, the announcement by Gold Fields to take over Yamana Gold, and that's started to shake up a little bit the industry. It's interesting when I talk to medium-sized companies, and we just had a couple of conferences in London about M&A targets. They are doing a lot of work. It was obviously put on hold a bit with COVID restrictions and not able to get out on site and kick the tires, but that's eased itself over the past 6 to 9 months. So I would definitely expect, especially with the big widening of margins, as the person who asked the question pointed out, that is a growing margin of valuations, market valuation, between the large caps and some of the especially the developers. So I think come mid-year into the second and third and fourth quarter, I would definitely expect M&A activity to pick up again.
Great stuff. Thanks, George. There's another gold-related question, so perhaps I can put that one to you too. I see gold as a hedge to currency debasement, yet the fund is not showing the benefit of this, notwithstanding sterling weakness. Is it only a matter of time and a need to be patient? What would make you change your approach on gold?
Well, I mean, it again. I think patience is the right word. I think people just jump in and say, "Well, I've taken on one theme and I'm holding gold as a hedge against currencies." Well, the past 2 months now, we've had gold down, the gold price down about 1 or 2% per month, but the gold equities have been down about 8 or 9, 10%. So until we get some stabilization, but it works both ways as well. Once gold price stabilizes, once they start coming through with the results and earning power, then we should see a recovery in the gold stocks itself. It's sometimes frustrating. We had the sell-off in general markets as well, and that's trickled down to the gold shares as well. So what would change? We're watching it very, very carefully, and obviously, if we do see a material change in inflation, coupled with rises in interest rates, without dipping the world into inflation, then we'll reduce it. And this fund is not a gold fund. We set out saying we'll probably always hold maybe 20% of the fund in precious metals companies, because it's a good risk diversifier, and it's a source of good companies with growth prospects, even in a falling or flat gold price scenario. So at the moment, what's happened the past couple of months is we've really had a bit of a meltdown, and we see how quickly we show the largest position being Kerr Mining. We took advantage when it fell in the early part of May to add to our positions, but since then it's up more than 35%. So back to where it was. So it's not really showing, but we're still seeing tremendous upside potential in the company. So I think just a bit of patience. It doesn't react straight away, and we've seen that before.
Great stuff. Thank you very much, George. We have another question concerning the size of the fund. I know that your fund is around 77 million sterling, actually. Is this a suitable size for investing? And I guess this relates to the market cap of the stocks that you're investing in.
Yeah, I think, Colin, we've always said that it's a really great time to invest, and I think some of our competitors with larger funds, they wish, because some of the 100 or 500 million with of 15, 20 million, and it's good to get in with companies around that 100 million to 500 million size, because that's our sweet spot, and I think the up to a level of around 500 million pounds, that is a very good environment, or very good size for our funds to do exactly what we set out to do. I think
Great stuff. Thank you, George. There's another question. Very roughly, in terms of correlation, do you expect what correlation do you expect between the performance of the fund and the one of the global equities?
I think Mark showed it earlier that of commodities against the S&P 500 or Dow Jones Industrial Index, and you've seen these big swings. So I'd expect, Colin, that it obviously depends on the underlying commodity prices, but remember, we're primarily looking at growth companies in an environment that we see the next 10 years as being more capital intensive than we've seen. There's been underinvestment in new projects in the sector, and that's why we're getting the squeeze, and that's changing now. We're certainly getting commodities funds are becoming more mainstream. We're getting capital coming back into the sector, and we're going to get some very good growth companies over the next 3, 4, 5, 10 years. And that's where we see the upside potential for investors investing in a fund like this to participate in this recapitalization of the mining industry that's really been starved of capital for 20 years. So that's where we would expect it to significantly outperform the general market. But I don't want to make a statement on the general market, but just the companies that we see right now.
George, I'd also add, I mean, if you want cold numbers, since launch of our fund, we're up 18% versus the S&P 500's up 6%. So, to George's point, that the metal market now and investing in natural resources is not a niche sector anymore. It's front and center of everyone's daily life. So, the takeaway should really be, even if you don't invest in our fund, do your homework on the sector as a whole, because it's not going anywhere. It's going to stay with us as a credible area to invest in longer term.
That's great. Thanks very much, George and Mark, for the presentation and for answering those questions. That's all we have that have come through just now. But if you think of any other questions, if anything else comes to mind, please get in touch with myself, Rachel, or John, and we'll put the questions to George and Mark and get back to you. Hopefully, I'd just like to thank you again for attending, and also for those who have supported the fund over the last year. Again, thank you for your support. And for those of you who are new to the fund, hopefully the presentations provided an indication of where the fund may provide diversification in a portfolio. So once again, thank you for your interest, and until the next time, goodbye for now.